Hi, I'm John Persinos, Editorial Director of Investing Daily, with a video presentation for Monday, June 5th. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. We're witnessing a hated bull market. Stocks keep rising, but Wall Street still seems perturbed. The gloomsters keep warning us that maybe we're in a bear market rally, that the surge of the NASDAQ means we're heading for a tech wreck, that inflation is still too sticky, that the artificial intelligence boom is an echo of the ill-fated dot-com boom of 1999. The dire predictions go on and on. Perhaps what galls the pessimists the most is that the stock market has the temerity to keep rising despite signs of an impending recession. Let's examine the data to see why this unloved rally keeps going. Job growth picked up steam in May, although the lagging effect of higher interest rates is likely to soon slow the pace of that growth. The U.S. Department of Labor reported last Friday that 339,000 new payrolls were added last month, roughly double the consensus expectation and up from the previous month. This was the best month of hiring since the gain of 472,000 in January and a modest reacceleration over the last several months, despite recessionary headwinds. The headline unemployment rate rose to 3.7%, still the lowest since 1969. The mixed data that show job growth with a rise in unemployment indicates that the job market stands on the cusp of a slowdown, which would be disinflationary. Other reports confirm the countervailing forces that are keeping the labor market in check. Job openings remain 3 million above pre-COVID openings, but they've fallen by nearly 2 million over the past year, including a decline of 1 million just over the last 4 months. Job postings are on a gradual downward slope as well, with employers cutting back in expectation of a recession. The Department of Labor reported last Thursday that for the week ending May 27, initial claims edged higher to 232,000, an increase of 2,000 from the previous week's revised level and below the estimate of 235,000. According to ADP last Thursday, private sector employment increased by 278,000 jobs in May, well ahead of the 180,000 estimate, and annual pay was up 6.5% year over year. However, ADP also reported that wage growth has decelerated. Job changers saw a gain of 12.1%, down a full percentage point from April. For job stayers, the increase was 6.5% in May, down from 6.7%. The ADP report stated, "This is the second month we've seen a full percentage point decline in pay growth for job changers. Pay growth is slowing substantially, and wage-driven inflation may be less of a concern for the economy despite robust hiring." So, moving forward, what can we make of this conflicting data? The upshot is this. The jobs market remains healthy, but the data counter fears of a wage price spiral. The economy is slowing sufficiently to cool inflation, but it's not on the verge of cratering. That's good news for stocks. The data help explain why the major indices have surged so far this year, despite headwinds such as the continuing Russia-Ukraine war, elevated interest rates, and an impending recession. During the past holiday-shortened week, we witnessed a relief rally after Congress and the White House reached an agreement on the federal debt ceiling. Take a look. The Dow Jones Industrial Average rose 2%, the S&P 500 rose 1.8%, and the tech-heavy NASDAQ rose 2%. The 10-year Treasury yield slipped 0.1%. Last week's equity surge was broad-based, a good sign because we've witnessed bad breadth lately due to a divergence between the technology sector and the overall market. The mania over AI has boosted the NASDAQ, but the New York Stock Exchange advanced decline line has slipped. However, market leadership is starting to broaden. Some analysts fear that we're seeing a tech bubble about to burst, akin to the internet-fueled boom and bust of 1999. However, the difference this time around is that the 1999 bubble was largely driven by rampant speculation in unprofitable companies, whereas the AI bonanza is largely fueled by hugely profitable mega-cap stalwarts. Mentions of AI during the quarterly earnings calls for tech behemoths Alphabet, Facebook parent Meta Platforms, Microsoft, Amazon, and Apple rose exponentially compared to the same quarter a year ago. We'll see if big tech's rally eventually spreads to the broader market and officially pulls the Dow and S&P 500 out of bear territory. The S&P 500 remains well above its 50 and 200-day moving averages, and the CBOE Volatility Index, the VIX, hovers below 15. A reading of the VIX below the threshold of 20 indicates a lower risk environment. Now let's take a look at the week ahead. Here are the salient economic reports scheduled for release this week. S&P U.S. Services PMI factory orders, ISM services Monday, U.S. trade deficit consumer credit Wednesday, initial jobless claims and wholesale inventories Thursday. The stock market rally appears to have legs, but if you're still nervous about the risks I've just described, consider the time-proven advice of my colleague, Dr. Stephen Lieb. As chief investment strategist of The Complete Investor, Dr. Lieb has produced a special report on how to survive the tectonic shifts facing the financial world. Amid the upheavals he sees ahead, Dr. Lieb says the most profitable investment opportunity won't be found among conventional assets. His research indicates it will be a tiny, under-the-radar play. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. Well, that's it for now, and if you have any feedback or questions, please don't hesitate to send me an email at mailbag@investingdaily.com.